Well, good morning and thank you for joining the Ellerston Global Mid Small Cap Fund webinar. My name's Lisa Rose and I'm the Head of Intermediary Sales at Ellerston Capital. Today we're joined by Bill Pridham, who's the Portfolio Manager for the fund. In today's presentation, Bill will discuss current portfolio positioning considerations, detail recent updates for some key stock holdings, and provide an update on fund performance for November. I'm sure many of you will have questions for Bill and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the questions section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Bill to start the presentation.
Terrific. Thanks, Lisa, and thanks everyone for taking the time to join me today. I know we're getting to the near end part of the financial year or the calendar year, and it's been an interesting several months. So I've got a lot to run through today, very much more stock specific rather than macro. So let's just hop right into it if you don't mind. Firstly, just what I like to do is just to remind on the philosophy. It's about connecting to tomorrow's returns today. That's all about being a concentrated fund. The 20 to 40 stocks. Absolute return focused. We're not benchmark huggers. We clearly look at it from a measurement point of view, but we don't look to replicate any benchmarks. Mid small cap bias. The sweet spot is that sub 10 bill, but at the end of the day, it's a large market out there as well. So you might see some larger companies still in that mid cap space, but we may see some larger companies come in there because when you think of Apple at $2 trillion. The investment universe is actually expanding, especially in the mid-cap space, which is really exciting as well. Also contrarian, not contrarian for the sake of it, like we've talked about. I'm not a value guy saying value is the only way to invest and saying momentum doesn't make sense. It's all about doing the work, putting the time in from an investing point of view to look at your catalysts and to see if they've come through in terms of the price discovery mechanisms we talk about quite extensively in terms of new IPOs or management changes. Fallen angels, embedded optionalities, there's a number of them there. And it's all about putting that time in to look where the market is potentially going to go from a stock-specific point of view and being there before that happens in terms of realizing that profit. And that's about connecting to tomorrow's returns today. So it's kind of summarizing that. So let's talk about positioning considerations, a little bit about the macro. Not a heck of a lot's changed since we last talked. We still have the political gridlock in the U.S., and that's creating a nice Goldilocks scenario for the market. What that typically means is less risk of aggressive tax or regulation policies from the Democrats who have taken control of the White House. We still need to see the Georgia runoffs from the Senate point of view, so that's still up in the air. But, the market kind of likes that gridlock because you're not going to see an aggressive policy come in to change the operating environment for companies. Central banks still incredibly accommodative. They're all focused on inflation, getting more inflation into the system, especially with the amount of debt now that we have in the system, and full employment. We're still a long way from that. So they'll keep the spigots open from a liquidity point of view from that sense. Prospects of fiscal stimulus, there's a lot of toing and froing. We're seeing the political gridlock in real time here, between the Republicans and Democrats about what package will come through. We've been talking for some time that we expect a skinny package to be done, a more targeted package to around businesses or individuals who are really feeling the pain rather than a broad brushed approach. It feels like we're getting closer to that realization, but still an unknown. And for the vaccine progress, look, we talked last time about the cases globally really spiking, especially in the northern hemispheres. And we've talked to a number of our companies, and what they're saying, it is concerning in terms of the number of cases, but we're also seeing the vaccine numbers come through in terms of vaccinations are happening now, which is really positive from that perspective. Clearly, we need to bridge that gap between the cases really picking up and getting vaccinations happening, and that's what the stimulus is all about at the end of the day. So we'll see how all those different mechanisms come together. The economic rebound has been much quicker than most people expected. It has been a sharp recovery from the March-April lows. That's really coming through in the numbers. When you look at the results coming through in Q2, Q3, it's really starting to come through in terms of operating leverage, revenues picking up, really picking up from that nadir of March and April in terms of when the world basically shut down. Now, in terms of the risks, we still have the risks of lockdowns. We're seeing that globally, especially up in the Northern Hemisphere, Germany, in the U.S., Canada, where I'm from as well. more lockdowns happening, but more specific. So they're not really shutting down the economy like they did in March, April. It's more about bars, restaurants, theaters, that type of environment. And if you remember in the last call, I talked about an article in the New York Post. They're saying, 80% of new cases are from bars, restaurants, and churches. So they're actually targeting those areas in terms of limiting, the activity levels in those areas specifically, rather than a broad-brushed shutdown approach. Stimulus may not get passed. I think that's getting less and less of a concern for me. The question will be the timing around it. Do we get one before Christmas? Hard to call. If we don't, then it'll be bigger in the new year once the Senate is confirmed who's going to control that and Biden gets inaugurated as well. So that's something that's still an unknown. The messy handover in the U.S., which you talked about last time, in terms of all the legal challenges that we're seeing from Donald Trump, I think that's becoming less of a concern. And a lot of those challenges are being thrown out. Biden's been declared. So I think that messy handover risk is coming off the table in my mind. Now, to talk about all those, which is great, but let's talk about the company. So one thing we do as part of our investment process is really talk to our companies, talking to the management. And it's all about a number of reasons why. So one of the more important ones for me is building relationships with the companies. We can talk to them and pick the phone up at any time to have a chat once we have those relationships in place. Secondly, and just as important, is just keep a finger on the pulse in terms of how the business is performing. And that really gives us a great feel on the risks around the business and making sure we're on top of these risks as well. And the third one is about us giving them feedback as well. We talk to them about capital allocation. They ask our opinion, which is great. So capital allocation in terms of strategies as well. So it's all about engendering that relationship, and it really helps us get up the curve from a knowledge standpoint, and helps us really be owners of the company, which we feel is very important. So when we do these calls, we don't do them at the time of the results. So we had a lot of our results in early November, late October, early November to mid-November, where a majority of our results came through. So what we typically do, we'll wait a few weeks to a month. Because if you phone them at the time of the results, you're just going to get the results. You're not going to get any updated information. So we tend to wait that month. And then we can get a good feel of how things are progressing post that quarter and get a little bit more anecdotal, near real-time evidence in terms of what's happening. So we've had 25 company calls in the last week and a half. It's been very busy from that perspective. Very enjoyable, I must say, because talking with them is great to get some good updated information and just to confirm that relationship we have with them. So in that, I'm going to talk through 10. It's still going to be a lot to talk through the 10, but I wanted to give you an update of what we're hearing from our companies. So I've always said we're mindful of the macro, but focus on the micro, and the micro are the companies. And what I've always felt and believe is those micro conversations build up your view on the macro at the end of the day to see where those risks are. And it's real-time information. I'm not waiting for next month's employment data. I'm not waiting for next month's ISM data. I'm hearing it from the companies, which I really find valuable from our perspective. So let's hop into the companies. Bureau Veritas, which is one of our largest positions, you'll see that in our top 10. So they're all about activity. So they're one of the largest testing, inspection, and certification companies globally. And they're very focused and leveraged to building an infrastructure, auto, transportation, consumer products, both toys, electronics, in terms of testing and certifying. And also in terms of reopening standards, they have a number of new products reopened with BVI. And it's all about making sure your business has all the protocols, the hygiene standards in place so you can open safely. And they provide that certification and make sure that's inspected as well. So they have a number of different drivers for the business, both from an activity point of view, we talked about the building and infrastructure, but also the new world in terms of reopening, making sure the businesses are safe, safely operating and giving the consumer and other businesses confidence to deal with them as well. So in talking with them, they're based in France. So they're seeing the sequential improvement they talked about, seeing no real surprises in activity. Actually, the certification business has rebounded quite strongly for them, which is quite encouraging. The lockdown measures that they've seen in Europe, they say, this is a common theme, much different than March, April. So it's much less of a broad brush. It's very targeted, and people are still, and businesses are still operating. So they're not, they're understanding the virus a lot better. They're understanding there's a vaccine on their way. They're understanding how to treat this thing a lot better as well. So there's a little bit more confidence in the system from an activity point of view, and they're seeing it pop through their numbers as well. The other thing they really called out were their ESG audits and social audits are really picking up dramatically. We all know that ESG is really picking up as a investing thematic, and it's a firm belief of ours as well. But what they're saying is the boards want to have proof. If we're saying to the market we're planting these tens of thousands of trees, well, we want to make sure they're actually measured and inspected, and they're seeing an incredible amount of activity pick up from that perspective. So like I mentioned, the macro environment for them is trending better. It is specific though. They said the soft lines is still a little bit difficult. So, in terms of, you think of the retail side of things, but on the other flip side, electronic goods, they're saying that is going very strongly. So from that perspective, it's really where you are. But in terms of activity levels, they're feeling very good about it. Grupa SCB, so they're one of the largest small appliance businesses globally. They have a large cookware business, and they also are one of the larger professional coffee producers in terms of equipment as well. So they're an interesting theme that we're seeing is years of trends being pulled forward into several months. And so that could be e-commerce, it could be digitalization of businesses, but they're also saying, this home health and wellness category of at-home cooking, it's actually been accelerated by the COVID. And it's interesting from an adoption point of view. They're actually seeing some pretty interesting trends happening in their appliance category specifically. Now, it's interesting. A lot of businesses went through a dramatic March, April period. They were no different. April was down 40%. May was flat. June was up 50%. So when you think of trying to manage supply chain, they said it was incredibly difficult to manage those peaks and troughs through those in just months. We're not talking over a year period. We're talking in months, which is incredibly difficult from supply chain. The good thing from their perspective, they are pretty vertical integrated from a manufacturing sense. So they're actually felt like they've taken a bit of share in terms of being in stock. A lot of companies that don't have that internal manufacturing focus weren't able to flex their manufacturing chains. So they actually benefited from that, which is great. They talked about Western Europe still being difficult, but much different from 6 months ago. So we're not seeing the full lockdown we did. All their plants are operating. One of their bigger plants was in Wuhan, and that was one of their big cookware, 100% operational now. So if they're seeing their goods are essential, that's what I like about a lot of our businesses. They're deemed essential, and activity levels are good. So stores are open for them. They have a lot of their own stores, which are all open now as well, but more importantly, all their plants are functioning. So it's just a good indication that from a supply chain they're comfortable with, and all their plants are running, and they're able to service that demand that they're seeing out there now. PTC. So PTC is one of the larger computer-aided design companies globally. It's one of those ones that really benefit from industrial manufacturing. It benefits from innovation. And what they're saying, certainly in Europe, they saw pressure in Q2, Q3, and in the Americas as well from an activity point of view, but a sharp improvement in Q4. And once you see these improvements come through, it tends to continue that trend. It's a real shift that they're seeing in terms of ISM data coming through, activity levels, like we're talking Bureau Veritas, really picking up as well. But interesting, one of my concerns with the company, and a lot of companies, was when you have their end markets come down, like let's say autos, in terms of even 5G, when you have end markets being under pressure from the ability to service them, clearly a lot of car dealerships were shut down. Does that mean the OEMs and the larger businesses will slow down their innovation cycle? But what they said, it was actually the opposite. Interestingly, they're seeing a shift, quite a conservative shift into electrification in terms of innovation, design, R&D, and that all has to be done on computer-aided design software, which they're really benefiting from. So a number of the companies, and Sensata, which we won't talk about today, they're very focused on automotive, and they're saying the same thing. We're seeing, from their perspective, it's all about the sensors. We're seeing a lot of design, a lot of innovation come through as this electrification thematic is really starting to catch a strong bid now, which is really interesting. The other aspect with PTC is this digital twin. We're seeing a number of large enterprises from John Deere to Saab they're all looking at their factories and our factory footprint. How do we get all our machines and devices inside these factories talking to each other? 5G is enabling that now. We've had the Release 16 in terms of the 5G standards come through now, which enables this from a standards point of view. And when you think about it, so if you have a machine on a factory floor, it's been designed. And if it's been designed on a PTC CAD software, you have the machine on the floor, you have all the specs in your software system. And now how do you put all that together? They have a company or a business called ThingWorx, which provides that mesh. It's all about that digital twin. It's all about providing the ability for all these machines to talk to each other, but also talk to that design in the software stack and making sure all those machines are operating at full potential, and also about predictive maintenance. So you can literally hold an iPad up. I think I talked about this in the last call. You can hold an iPad up to a machine and that bearing is operating at 60%. We better fix that. And you only can do that if you have the specs from the inception right to the plant floor, and they provide that as a one-stop shop, which is incredibly interesting to me. So they're seeing a lot more adoption from that. They're getting very excited about that trend, and it was very much a focus in the call that I had with them in terms of this opportunity that they're seeing now from that perspective. Now we shift to QTS, so it's a data center company in the U.S., and so it's interesting. Jeff was saying they're seeing a lot of inbound demand from companies. So when you think of COVID-19, what's really happened with that, and we talked about e-commerce, we talked about digitization of companies, they all are understanding and realizing that we've really got to pull forward our digitization and digital trends within our businesses. And they're seeing a lot of inbound demand from enterprises. It's all about them saying, we don't want to own the servers, we want to go inside a data center where it's actually a lot more connected, and we don't want to have the CapEx associated with the servers. And with digitization, I got to get closer to the customer, and that means I need to be inside these data centers as well. So he was incredibly excited about these opportunities he's seeing from the enterprise perspective, also from the federal perspective. They're one of the few companies that have FedRAMP approval across their data centers. So seeing a lot of federal deals come in as well, which is quite interesting. So he's seeing a lot of companies talk about we have to reorganize our infrastructure. How do we get closer to the customer? How do we streamline our businesses? How do we look at our businesses from an operational point of view, given the work from home dynamic is probably here to stay? Not to what we had in March and April, but there's going to be a certain level of work from home which is entrenched. So these businesses have to adapt, and they are one of the platforms to help them do that from a data center point of view. So he was quite excited about that opportunity for them. They're seeing record bookings come through from these enterprises, and that's going to flow through for several years, which is great because it takes 12 to 18 months to put these bookings into revenue. So you're actually building this annuity revenue up as a QTS shareholder, which we really enjoy. So WillScot Mobile Mini, they bought Mobile Mini several months ago. It was integration of a storage business and their modular office. I think I've talked about Mobile Mini and WillScot in the past. And it's interesting from an activity point of view. It's all about, they have like 45% share of the modular office markets in the US. So if you're going past a construction site, you'll see those office buildings on site, that's them. And also storage. So Mobile Mini was big in the storage. So now they combine that capability together, which gives them great synergies. So he was saying, we clearly are seeing these activity levels improve sequentially. That's even without non-res really starting to pick up yet. The big thing that they're seeing now is the smaller players are having quite a bit of difficulty in terms of a couple angles. One was national accounts and sophisticated customers really want a national player now. They want somebody that has sophisticated systems in place and are able to deal with them and service them across the continental U.S. and in Canada as well. A lot of smaller players are having difficulty do that, especially when you layer in the needs from a PPE perspective and hygiene perspective. Smaller players aren't really built for that, where these guys can do that given their national footprint. So they believe they're taking some share, which is great. Also from a new market opportunity. He was saying we're seeing a lot of different social distancing business opportunity pick up. It's clear they're getting benefits from the testing side of things. So hospitals and that need to have separate testing areas, and they're providing that modular testing opportunity. But more importantly, they're seeing businesses look at how they're doing business, and they need to have a bit more space. So they're actually seeing on these sites you need to have an entrance office. You need to have a separate office for segregation and testing, so to speak. There's a number of different opportunities to pick up from that sense, which is really helping the business go through this period. Like I said, it's a difficult market for smaller players, but they're really they're performing quite well. The business is generating double-digit revenue growth. We've had a difficult year from a volume perspective, so that'll give me easier comps for next year. And also the underlying markets in terms of Dodge Analytics, they're saying they're expecting it to grow next year. And I think it will. When you think of the liquidity that's put into the system now, I think you're going to start to see economic activity from a non-residential construction point of view come through. I think you have bipartisan support for infrastructure spending increases as well. So they're delta one to all that, which is quite interesting. But at the end of the day, they actually don't need that underlying growth of the markets. They'll get double-digit growth just from their pricing initiatives they have in place. Love to see the underlying market start to pick up as well, because that'll give a double-pronged benefit to this business, which we're really going to enjoy next year. Tempur Sealy, I've talked about this company quite a bit. It's a bedding company. It's one of the largest bedding companies and mattress companies globally. They're seeing a large shift of dollars into health and wellness. That people are spending more time at home, and they want to spend it comfortably. And they're actually seeing quite a bit of demand pick up from that perspective. I think they've had a bit of pull forward this year, but I had a call with the company, and they're actually saying we're seeing a lot more opportunities than we had expected into next year as well. We have a U.S. tariff put in place in terms of anti-dumping of mattresses, which was just enacted. They're revamping their whole Sealy line next year, which will give them a large uplift as well. And if you remember, the first half of the year was difficult for them from a COVID point of view in terms of shutdowns as well. So you're going to see a business still grow quite strongly next year on the back of all those initiatives. That said, supply issues are still rampant. So they are having trouble keeping up with demand. When you think of March and April, a lot of supply chains shut down, and it takes that supply chain time to pick up. So you have this domino effect that, as this supplier picks up, well, I've been waiting for that, now I can start going. The next one's waiting for that supply as well. So it takes time for the supply chain really to pick up, and it's feeding through their supply chain. They recently upgraded the numbers last week on they upgraded the Q4 numbers again. And that's even with supply chain a little bit worse than they expected in their Sealy and private label brands. So they're having trouble keeping up with demand. Supply chain's very stretched. They're adding capacity, which will come through next year. So you can see a number of these initiatives come through, which will drive growth for next year. One thing that was quite clear from them is omni-channel. I think that's a massive thing that retail companies need to be very mindful of, especially when you have the Amazons of the world really taking share. People still want to touch and look at the product, especially with the mattress as well, but you need to have research done online. So they're saying like 70 to 80% of the decision is made online, and then they go to the final stage of going to the store and looking at the mattress or the bedding products to get that final confirmation. So they're really focusing a lot on this omni-channel strategy. They've been doing it before, but it's actually brought forward the urgency of it now, given what we're seeing from a consumer point of view. So in the retail stores, what they're saying, we're seeing traffic levels down, but conversion up. And it makes sense. When you think about it, I've done a lot of my research. I know what I want. I just want to get that final confirmation, and I'll go in the store and get that. So traffic levels down, conversion up, I think is a broad theme that we're seeing as well across the groups. Assurant. So Assurant is one of the larger players in terms of mobile phone trade-ins, mobile phone warranties. They have a number of different products. They do all of T-Mobile in the U.S., and now with T-Mobile buying Sprint, they'll be doing all of Sprint's as well. So if you go into a T-Mobile store and trade your phone in, they take that, they refurb it, they fix it. They handle the extended warranties you're going to put on your phone. They handle the any basically Pocket Geek. They have it what it's called in terms of if you have problems with your phone, they'll deal with that. There's a number of services they're layering into that. They also have a large business in automotive, so they provide your extended warranty. So if you're buying a new car or a used car and you put a warranty on that outside of the manufacturing warranty on a new car, they provide that extended warranty. And on a used car, they provide the warranty on that. So they went through quite a difficult time in March and April. But it's interesting talking with the company from an activity level, and you'll hear this a common theme when I'm going through these company conversations. You know what? We're seeing lockdowns and we're worried about cases, but activity levels are still pretty good. And Sean was saying, for the most part, business is performing very well. If you go into a business like a Home Depot or any of the car dealerships, they're full. Car dealerships have had trouble with inventory. They've had trouble with restocking. Again, that supply chain is taking time to build up. So they're seeing good activity levels. Outside of what you're hearing from the case levels, they're seeing good economic activity. Now, the 5G phone, this is in their mind, and this is one of the thematics around this business for us as well. We've had the 4G phones, but now 5G as it comes through will create or potentially create a super cycle trade-in. And that's, people have been looking for this big shift. The last several years, we have nice iterations of phones, but no big technology shift. Now, 5G will be a big shift in terms of the phone itself. And they anticipate it's going to take a few months because they're saying, from an infrastructure point of view, the AT&T and Verizon are still building the 5G infrastructure, which is great from a testing point of view from, the key sites and the Inritsus, which we own as well. But it's going to take time to get that infrastructure in place. Once you have that in place, you could see this 5G super cycle come through. And they're saying more second half next year is when they anticipate that really to pick up. So it's an interesting driver for this business over the next several years as we see that come through. They said, April, May, very difficult from new policies. Businesses through that period down 40, 50%. It's incredible the drop we've seen, but the snapback has just been just as pronounced. And you've seen the new market really strong in the U.S. You've seen the used market, both here in the U.S., very strong as well. So what they're saying, we're seeing good snapback, and that's continued post-quarter as well. So it's just a good indication that these trends we've been seeing are still entrenched and actually potentially building on themselves, despite what we're seeing from the case numbers that, globally out there. XPO Logistics, I literally just talked to them this morning as well. They're getting a lot of inbound demand from customers looking at their supply chains. You'll hear supply chains. I talk about supply chains a lot. It's a business continuity issue. It's a business operational efficiency issue as well. And from what we've seen with this demand profile in different sectors like the autos, electronics, and especially when you think of the U.S.-China trade war and now COVID has accentuated these issues, companies are really focused on where they're getting their product, how can we get it closer to the consumer and do that efficiently. So that's a common theme you'll see across the portfolio. So they're seeing a lot of inbound demand from that contract logistics business. Again, restocking across the board. And a lot of companies can't keep up. I have a few companies that are all saying we just still can't keep up with supply or demand, because supply chains are still trying to catch up with this. It's getting better, better in stocks, but it's still coming through. So they're seeing consumer companies reach out to them more than ever. From a truckload point of view, from a contract logistics point of view, to make sure we can get this better. Spot rates are very high at the moment, which is benefiting them from a pricing point of view. Auto customers are ramping back up as well, which is quite attractive from a number of our positions in terms of we're going to be cycling a very weak year next year, which is pretty exciting from an auto category point of view. But again, we talked about the lockdowns, and they're saying, governments are, a bit more selective this time in terms of really where they're focusing. Clearly, bars, restaurants, and the like, but they're seeing it as well. Activity is still going quite well for them, which is quite pleasing from an operational standpoint. Now, they just announced a couple of weeks ago they're spinning off their contract logistics business. They felt that, from a multiple point of view and from a shareholder focus point of view, they wanted to have two separate businesses: transportation and contract logistics. Talking with them this morning, it's all on track. They're going to do a Form 10 early in the first quarter next year. And there seems some pretty interesting opportunities from a leverage point of view. It's more about focus. And that's what I like about companies that are improving their focus. And it's interesting. We'll see some pretty interesting commentary from them over the next few months in terms of what they're doing and how they're increasing the leverage inside these businesses as standalones, which is quite exciting. And finally on Comerica. So Comerica is a regional bank in the U.S. We bought a few regional banks. We talked about them on the last call, but we bought them a couple months ago. So Comerica's got a 7.1 billion market cap. It's got 82 billion of interest earning assets on their balance sheet. It's a business which, when you think about loan to deposit ratios, just over 70%. So for every dollar of loan, they have $1.30 of deposits in place. So it's, the leverage and the scale in these businesses are massive of trapped liquidity in these businesses. So again, what they're saying, cases are certainly ramping, and these are all real-time observations, which is great. But they're seeing business activity pick up. They're seeing smaller businesses. So they're typically in the SMB market. They're not at the big end of town. That's more the Wells Fargo and Bank of America's. These are more your nuts and bolts, small, medium-sized businesses they will service. And they're seeing more confidence come through in terms of activity levels. The trouble is right now there's so much liquidity, loan demand is still subdued. But if we see the supply constraints continue, if we see economic activity pick up, we could start to see loan activity pick up, which is an important driver for these banks at the end of the day. Their economist is a bit more guarded. He's looking for these stimulus packages to come through. He feels that they're necessary, and I believe that there are pockets that are definitely necessary in terms of businesses and people that are still struggling out there, and they will come up with some targeted package around that. And it's still unclear how it's going to be targeted, but it will be targeted from a stimulus point of view, which will be great. These banks are really leveraged to inflation, rates picking up. We're starting to see that happening a little bit. And if you think of supply constraints and what's happening there from a tightness point of view, I think you could see a bit of inflation continue to feed through the system. Clearly, the banks benefit from that. But the other angle, it wasn't part of my thematic of investing, but it was a real, in terms of our initial conversations, it was something that they believe will happen as well, and that's consolidation. They have a lot of excess capital in these banks' balance sheets. I talked about the loan to deposit ratio, massive amount of deposits out there compared to the loans. So it makes sense from a consolidation point of view to put these together. There's thousands of banks in the U.S., and it makes sense to put them together. And we're starting to see that now. It's interesting. Huntington Bank Shares bought a business called TCF. It was around a $6 billion acquisition size. And what they're saying is that the synergies in terms of opportunity are going to be massive from this perspective. They paid about 1.5 times book, which is interesting when you look at the banks that we own. They're around at book or slightly below book. So good valuation support there as well. So effectively, when I think about the banks from an activity point of view, we need to get those loans happening. But what I'm hearing from the companies at the ground roots level is that activity levels are still good, and we could see that happen into next year, which will be interesting to watch. Now, we put all this together to sum up. So, we've talked about the economic activity really starting to pick up, or not starting to pick up, but maintaining its pace despite all the cases that we've seen out there. And that's important from an investing point of view to get that feel from the companies that it's actually the cases are rising, but activity levels are still good. And that's important to keep the finger on the pulse from that perspective. The other thing is the inventory restocking. We're hearing it from a number of our companies. So AZEK on the right-hand side is composite decking in the U.S. We've heard it from Scott's Miracle-Gro. We're hearing it from Tempur Sealy. There's a lot of supply chain constraints still in the system, and we're still getting the inventory restock, which helps just more cyclical style businesses like an XPO Logistics or a Keon Group, which is factory automation in Europe as well. Supply chains are stretched, hard to keep up with demand. No change in terms of that, but I think they're starting to catch up a little bit now. So all this points to early cycle. It's incredible to think about now. We are talking about early cycle recovery. Given in January, Feb, we were talking about late cycle. It just shows you how sharp and dramatic that pandemic impacted global economies. So we go from a late cycle economy to now we're early cycle, and that typically benefits mid-small caps dramatically. You've seen that in the numbers. If you just look at the U.S., the Russell is outperforming the S&P by over 300 basis points over the last few months. You can see the shift into the mid-small cap space. And it also benefits the more cyclical value businesses. And that's what we've been looking at the last few months. We've been shifting. And I talked about on the last call, if you looked at our barbell several months ago, the value growth would have flipped to the other side. But we've been shifting the last several months into this trade, it's not a trade, it's a real thematic that's coming through and has a long tail behind it. So these value stocks, the regional banks, the infrastructure stocks, the trucking companies like XPO Logistics, Keon Group, which is the second largest forklift operator globally, factory automation. Those types of businesses are really going to benefit from all this. And the reason we do these calls is to make sure that thematic is still in place. And everything I've heard, there's another 15 companies that we've talked to. Everything I've heard is confirming this trend come through. Cases aside, activity levels are fine. So it gives you a bit of confidence from that perspective that this thematic that we're investing in terms of the value trade is entrenched. And I believe it has several, it's got quite a few quarters to go. It's not a one quarter phenomenon. It's quite a several quarter phenomenon that we'll see come through in terms of the numbers from that perspective, which is great. So on that, performance-wise, look, November was difficult, I must say, from a rotation point of view. So we typically aren't going to be in fossil fuel stocks, energy stocks, that area of the market. We're not going to be in cruise lines, that type of thing, typically. It's not something that would preclude, but it's not really in our wheelhouse of competency, I believe. And those stocks really had a strong November. It's incredible the rotation we saw that month. Pleasingly, we had a decent month, a great month from an absolute perspective, up over 6%. If I could do that every month, I'd be incredibly happy. Relatively, didn't keep up. We're below by about 2.7% relative-wise. But at the end of the day, 1 month does not make a trend. This month has been good, both absolute and relative. We're starting to claw that back a bit, which is great. I think you've heard me talk. I'd rather have absolute any day of the week over a relative performance. And from an absolute perspective, it's going great year to date. So when we look at from July to date, so it's up around just under 15% year to date. But the interesting thing is the stocks themselves are up over 21%. It's the offsetting factor there has been the FX. So as you know, it's an unhedged fund. And the Aussie dollar has been incredibly strong in this risk-on environment, which has detracted around 7% from performance. That said, I have found the Aussie dollar to be one of the greatest hedges in a risk-off environment. So, risk-on is great, but let's face it, we're not going to have a risk-on environment forever. And when we do get a risk-off environment, that Aussie dollar will probably weaken at some point and create will definitely create a buffer in terms of absolute numbers. So I'm really happy with over 20% share price, absolute stock performance. Yeah, I'm not happy with 7% FX impact, but I understand that's the nature of the beast, and also it's a great hedge in a risk-off world at the end of the day as well. So that's the November commentary and FY year to date. If we look at since inception, just under 15%. I'm very happy with that. If I could continue that, I'd be incredibly happy with that performance. You can never say what it will be over time, but I think with our focus and our broad-based approach, we have businesses that will benefit in a reopening world, quality businesses that benefit in a reopening world. We have businesses that will benefit in a digital world as well. So as you can see in that barbell, I know we're more value cyclical right now, but we also have some really strong digital businesses which we can benefit from this shift from a digital world perspective. So that's I know it's a lot of information there from a company specific, but I think if you know me, that's my bread and butter are the companies, because they will tell me what the macro is going to do typically as well. So with that, I think we should go into Q&A, Lisa, if you don't mind.
Thanks, Bill. There's some great questions that have already come through. The first one for you is, how do you see your barbell positioning changing in 2021?
I think it's a good question. It depends on opportunities, and you can never say where it's going to go. I think right now, where I'm positioned now, I think that'll be entrenched for a while, unless I see a major shift, a more aggressive shift in terms of economic activity, and I can actually add to that. I think the barbell could actually get more weighty on the left hand, the value side, because those businesses, when you think of a WillScot, when you think of XPO, there's so many more catalysts to come through with them. And I can see, 20, 30% up from here in a lot of those names, which is quite interesting. So even though we've had a good run, there's still some good leverage coming through in terms of operational, and that drives the share price. So you may see that left side increase just from organic share price performance. That said, never I would never say I would say that's just totally entrenched for the year. But I think if you look at it today, I think that's probably the ratio you'll see into next year for a while. I can't see that changing too much.
Thanks, Bill. Next question that's come through. Cash seems to be sitting at about 8%. Is this a normal level, or what changes would you need to see from the macro environment to deploy this?
It's actually even lower than I've typically been historically. I've been in the double digits. To be in the single digits is it's not abnormal, but it's at the upper end of what I've been typically running at. I'd say if you're 90% plus invested, you're pretty fully invested because you want to have a little bit of dry powder for different opportunities that come your way. You don't want to have to sell something just to buy another business which looks quite interesting if that existing business looks great. And I also feel at this level, a new company really has to fight to get in, which is a nice place to be. So you have your existing companies in place, and if you have a new idea, it's really got to fight to get in from a opportunity point of view, from a share price point of view, and discount to intrinsic value. So I don't think you'll see that cash level increase dramatically from here. I don't think it'll decline dramatically. If it declines from here, I'm seeing some more opportunities come through to deploy. If I get to that mid 90s, I'd be really fully invested from that perspective. But I like to keep a little bit of dry powder in place for different opportunities which may come my way. If markets continue to rally, though, I'm very focused on my risk reward and looking at the businesses that are getting closer to fair value, and I'll trim. And I'll take a bit off the top. So you could see if the markets continue to go the way they are, you may actually see that cash level increase as I add or as I take away from companies that have actually gotten to fair value and my risk rewards change quite a bit. So the cash is a function of opportunities. It's not a function. I don't say I need to be 8% cash or 10% cash. It's really a function of the stocks and what I see in the markets at the end of the day. So it can change.
Thanks, Bill. Next question that's here for you. Option Care appears to be a new name on your portfolio barbell slide. Can you give a quick overview of this business?
Yeah, sure. It's actually been buying more of it recently. So Option Care Health, it's all about at-home care. So it's home infusion. So I've owned, if you remember or if you followed me, I've owned Amedisys, which is at-home care from a hospice and at-home care. When you leave a hospital, they look after you when you're at home. So I'm a big believer in at-home because people don't want to go into a hospital to get treated. So the elevator pitch on this one, $100 billion is spent on infusions in the U.S. annually. Around $13 billion of that is spent at home. Now, at home is taking share from the hospital setting pretty aggressively because there's a number of different reasons. One, the customers or the consumer, you and me, like to be treated at home better. I don't want to have to go to a hospital to get the treatment, so it's a lot more convenient. I don't want to get infections at the hospital, so I don't feel as much at risk. And you think of in this world of COVID, I'd rather be treated in my own environment. So people like us like that home infusion opportunity better. The payers, the Aetnas, Cignas, they like it better because it's close to 50 to 60% cheaper to treat you at home rather than in a hospital. So the payers love it, the consumers love it because it has so many benefits from a win-win perspective. Option Care Health is the #1 independent player in home infusion. They have about 25% market share. They will grow revenues at a high single, low double-digit rate. Their model grows earnings at 2 to 3 times that. So from an earnings perspective, you'd be growing at 20 to 30%. They are getting more market share with the payers because they have 96% coverage of the U.S. They're getting more market share with drug companies because drug companies are looking and saying we can do therapies with you and do testing with you across the national footprint. So they're getting market share gains in the number of drugs they're administrating, the number of payers that they're getting on board, and the penetration within the payers as well. If you look at it from a valuation perspective, Amedisys is trading over 20 times next year. Option Care Health is trading around 12. I believe Option Care is growing faster. It's actually less risk from a regulatory point of view because it's all payers that pay their money. It's not about the government. And also, it's a new company in terms of they bought a business last year called BioScript, put #1, #2 together. So now we're benefiting from the synergies. They're going to excel on the synergies. So it's a new business, and it's about at-home infusion, and it's at-home infusion, which is taking massive share from the hospital. So that's kind of the elevator pitch, and it trades at a 10-point discount to what I feel is a good comparable in the market today.
Thanks, Bill. I've got one more question for you, and I might give participants the opportunity to send through any final questions for Bill. Bill, this last question for you, you spoke about pull forward revenues last month. Is Group SCB not highly exposed to this? Why do you continue to hold it?
So it's an interesting question, and we had it last call as well. Group SCB actually was really impacted in this year, for this full year. Their revenues will be down 5 to 6% for the year. Earnings will be down over 20%. So actually, there's very little pull forward. This quarter, they started to be positive. So literally, we're just starting to get positive from an earnings perspective. So it's actually been the opposite of that. So Q1, Q2, one of their bigger factories was in Wuhan, believe it or not, in terms of cookware. It was shut down. So they're still trying to catch up from a demand perspective. They've got that factory up and running completely now, but they're still trying to restock what they had lost. So no, it's interesting from a pull forward. It's actually just started to recoup. There's been no pull forward in the numbers come through. I'm hoping next year we'll be cycling these really negative numbers. The other aspect to think of with Group SCB, they have one of the largest professional coffee businesses globally as well. So they sell coffee equipment to the likes of Dunkin' Donuts, hotels, restaurants. That business has been obliterated this year from an earnings and revenue perspective. So that business, as we get some reopening come through, that should start picking up as well. So we have quite an easy comparable period coming through. Trades at 9 times next year compared to a lot of comps that double that. I'm a very happy holder of that business.
Thanks, Bill. Well, we don't have any further questions that have come in. We've got some positive feedback from participants, though. Great presentation, Bill. Congrats on your stellar performance. I might hand it back to you, Bill, just for a final comment before we close off, and any closing remarks.
Great. Thanks, Lisa. So I know there was a lot to take in on this call. I think the thing to take away, like I talked about, is activity is still pretty good out there, despite what we're hearing from the headlines in terms of cases. We're seeing inventory restocking still continue. We're seeing supply chains still stretched. You want to be in the right areas, clearly, with all this. I believe, if you look at our positions, we are in the right areas, and it's some great questions around Group SCB and the pull forward and the risks around that. You think of an Option Care Health, it's a much different business. And if I put those together, and when you think of what we talked about with the different companies, all quite different in terms of what they are, but there's a common thread intertwining them, which I like. And as you've seen from that barbell, which we'll continue to update and continue to show you where we're at, because I want to be very transparent of what you're exposed to from a thematic and stock perspective, especially. We're seeing some really interesting opportunities out there. It's even though markets have rallied, we still see some good upside in our names. The names are getting stronger. We keep on top of them from a management perspective, and in terms of the businesses as they're operating as well. So I hope this call wasn't too much in terms of micro commentary, but I just wanted to share what I've been hearing, because we've talked to most of the portfolios in the last 2 weeks, which has been tiring but exciting at the same time. And I wanted to share that with you from a transparency perspective. Outside of that, it's been a big year. We've all seen the sharpest drawdown at least in my investing history, and the biggest pandemic concern we've seen in our lifetime as well. It's been a tiring year from that perspective. It's created opportunities. It's really, I think, provided diversification opportunities in terms of investors, really to get on businesses. If you look at the barbell, who benefits physically, who benefits digitally from all this. And we're really focused on this because, if you listen to Jeff at QTS, enterprises are reinventing themselves. And I want to be on the right side of that trade as well. So it's been an interesting year. Thank you for the feedback. I really appreciate it. The biggest thing is stay healthy, have a great holiday season. And I really do look forward to talking with you in the new year.
Well, thank you, Bill. So for all our participants, recording of the session will be sent through to you shortly. However, if there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly. We're more than happy to help with any matters as required. Thank you all again for attending, and I trust you have a good rest of your day.
Okay, stay well. Bye-bye.